Hey, Big Bulls, welcome back to another edition of Bullseye. And today we've got three very interesting stories for you.
Today we talk about Zomato's Blinkit expansion, we talk about a Make in India stock, and we talk about what Trump's presidency means for Indian stocks. Zomato announced its Q3 results and it's dropped around 18% in the last 2 days. So what's working and what's not working with its main businesses, that is food delivery and Blinkit?
Okay, so as we record this right now on Thursday morning, there has been a slight recovery in the stock. So it's not as scary as 18% yet. So it's kind of recovered and it's down 10%. But the primary thing over here is the results that they've announced, right? And let's break it down into the two big or the key areas for Zomato, which is the food delivery and the Blinkit instant grocery delivery business. Now, in terms of the food delivery business, Saloni, what has happened is since mid-November, there's been a bit of a slowdown, right? People aren't ordering as much as they used to. There's been a slowdown on that front. But management commentary, if you look at it, they're not overly concerned with this. They think it's just a small blip in the overall growth story for food delivery. And they believe that this will bounce back over time. So if you look at the shareholder letter as well, which they publish every quarter, you'll see that most questions and answers, they do it in a Q&A format. And most Q&A is focused around the Blinkit expansion over here, right? So the key thing over here when it comes to Blinkit is how much money they've actually put into expanding the Blinkit operations, right? They're opening more and more dark stores, and they're doing this because there's intense competition that's heating up from both Swiggy, Instamart, as well as the new kid on the block in many ways, which is Zepto. If I look at the numbers to just highlight some of these things, they've spent a capex, the overall capital expenditure of 370 crore rupees on Blinkit expansion, and 368 stores have been opened up. But more than that, what I want to highlight over here is earlier Zomato had said they would open 2,000 Blinkit stores by December 2026. That is the guidance. But now in the latest quarter, they've said that they're planning to actually move this forward by an entire year. So by December 2025, they want to open 2,000 dark stores.
That's crazy. And I think that's the rapid expansion they're talking about.
Exactly. So every brokerage, whether you look at, the Nomura's or the Macquarie's, everyone's highlighting that obviously this expansion is going to come at the cost of profitability for the time being, right? So that will hurt short-term profits. But the hope is that in the long run, once they're up and running and once that capex is done, it'll be a boost to profits. But for the time being, at least, it's a bit of a negative factor.
So dark stores, I guess, are, hidden warehouses for online shoppings, right? Where they ensure that the process of fast delivery happens, quickly shipped and delivered, right? And in quick commerce, I guess it's very important because more and more dark stores you have, it helps you to reach more customers. It helps you to ensure that your rapid delivery is done on time, if I'm not wrong.
Yeah, exactly, right? So in a sense, it becomes like the holy grail for deciding, what happens with a, instant delivery company. They need to get the location right. They need to get all of it right? But the biggest competition over here, obviously, is Zepto, which is an unlisted company against Zomato, which is a listed company. And that gives it a bit of a leg up in the overall, ecosystem because Zepto can go hell for leather and focus on growth over profitability for the time being. They've raised $1.3 billion last year. So it's focusing on growth over unit economics, right? So that's helping Zepto really expand and putting pressure on listed companies like Zomato as well to kind of follow in its footsteps.
Okay, but I do have to ask about this report that I've seen from Macquarie. They have given a price target for Zomato that's just rupees 130, right? And it's at around 220 rupees today. So that's like a crazy downgrade.
Oh yeah, of course. But Macquarie, if you read the report, Macquarie does believe that Zomato is a solid food delivery and instant grocery play. But it's the heated competition for the time being that is causing, the brokerage to kind of downgrade it. But at the end of the day, let's also face it, Zomato by itself is an expensive stock. So Macquarie's reasoning right now is that there is no margin of safety that's, left in the stock price when it's, such highly valued. But I also want to point out one other thing to you, Saloni, and to our listeners as well, which is that we need to take all these brokerage price targets with a pinch of salt. If you go back to Macquarie itself, a couple of years ago, they had an underperform rating on Zomato. And then out of nowhere, it became an outperform. So everyone was like gung ho. There was a solid narrative that's being built about Zomato. But now again, because of this results and there's been a bit of a miss, there's another underperform rating coming in, right? So it's a bit of an up and down. So it's up to you what story you want to believe in and what you want to play. So Saloni, another stock that has been in the news with its share price dropping is Dixon Technologies, which has seen a 17% fall in 2 days, right? And this is despite its profit for Q3 doubling to 217 crore rupees. So what's going on?
But before that, just a bit about the company. Dixon Technologies, it's India's biggest homegrown contract manufacturer. It makes stuffs like LED TVs, semi-automatic washing machines, mobile phones, IT gear, etc. Right? And contract manufacturing is when companies hire third-party firms to make their products. And Dixon has gone from just making LED TVs to now becoming a major player in the whole Indian electronics scene. Right? We called it a Make in India stock, earlier because this is one company that has capitalized fully from the PLI scheme. Now, this scheme obviously was something that was launched in 2020 to boost local manufacturing, right? So the company's story also really took off after that scheme because after that, many big names like Samsung, Motorola, Nokia, and Xiaomi, they have all been turning to Dixon for manufacturing.
Right. So, which also explains why in the past 5 years, there's been a massive run up of 1,600 odd percent in its share price, right?
Yeah, that's true. Though this mad surge had, made the stock very expensive, of course. And even though the Q3 earnings are a beat, they've, met estimates and actually beaten estimates, brokerage Jefferies noted that this risk reward is pretty tight now. And especially with companies' price to earnings ratio, which is very at a higher end, right? Now, most of Dixon's growth has come from their mobile and EMS segment, which has jumped to 89% in Q3 from 67% in the last quarter, right? And this boost is thanks to more sales with their existing clients and also the Smarto acquisition from last year. So Smarto is known for brands like Infinix and Techno, and it's a key player in India's feature phone market, right? And this acquisition was done as it fits Dixon's plan to expand in this segment and obviously reach more and more people and reach its strategic goals as well. But all this gain from the AMS segment was partly offset by a 32% drop in its consumer electronics business because there were not much sales in the TV segment, right? Still, Jefferies expects that the solid sales and steady margins will continue through FY26 for the company. And this is when Dixon's also planning to dive into the display fab manufacturing units, which are known for semiconductor manufacturing, to take advantage of all these available incentives from the government.
Right. So it doesn't seem like the story is dead. It's just that because there's been a massive run up, there's bound to be slight, corrections in the stock price as well. Again, not a stock recommendation, but it's a story that again has been playing out with PLI with Dixon.
Yes. So Donald Trump is now officially the 47th president of the United States, and he has been very vocal about the high tariffs that he plans to impose on many countries, and also his mantra of making America great again, right? And also his future economic plans are a bit of mixed bag and hard to predict. So what's happening there?
Well, it's always tough to predict exactly what he said, right? But the thing is, we have seen FII outflows, foreign, institutional investors have been exiting India in the past year or so, right? It's not been very positive. Now, the feeling that most experts have is that Trump coming into power could actually exacerbate the FII outflows a little bit more because, a lot of pro-US policies that happen in terms of making America great again, that could make American stocks a little bit more attractive. And you could see FII money actually flowing out of India and into countries like the US again, right? The other thing is, if Trump's trade policies, one of the fears is that his tariff, imposition and every other policy that he has, it could turn out to be inflationary. And if that happens, the US Federal Reserve, which is their central bank, they could hit pause on cutting interest rates, right? Because now they'll be more worried about controlling inflation rather than propelling growth. And if that happens again, that could put pressure on treasury yields, affect capital flows into India, and that could hurt the Indian stock markets again, right? Plus, there's this dollar strength as well, which we have to talk about. And that will keep pressuring the Indian rupee. At the moment, it remains the safest bet. So again, a lot of emerging market investors could be looking at more safe haven options and moving money into the dollar, right? So that's another thing. As now, one interesting quote that we came across was by Swaminathan Iyer, the consulting editor of ET Now, who said, and I quote, I would say neither the rupee nor the stock market is going to look very healthy after Mr. Trump comes to power, right? So that's one thing that people are pointing out for India. So another part where it could have an impact are sectors such as pharma and IT. So there's a lot of revenue that these companies derive from US operations. But there is a bit of an anti-immigration stance in many ways. They're clamping down on H-1B visas, which are crucial for workers. So that could have an impact on these sectors as well, but also energy companies, which may face higher tariffs on solar panels and batteries, right? So that's the overall sector-wise impact that could happen as well.
I was also going this analysis, what happened during Trump's first term, right, which was around 2017 till 2020. So India's benchmarks that time actually underperformed the US, right? That is a time when Nifty gained around 38%, while Nasdaq soared around 77%.
Yeah. So again, we don't know if that will happen again, but Trump 2.0 is definitely adding to some volatility in the market. But one interesting contrarian take by Elara Securities is that they looked at Citi's US Economic Surprise Index, and they said that a stronger US economy actually has a 25% correlation with FII inflows into India. So this is contrary to the belief that a strong US economy leads to outflows. So it's definitely a wait and watch, and I'm sure a lot of investors will be hoping that the Citi's surprise index for the US is actually going to come true. All right, so that's it from us for this week, folks. We hope you've enjoyed this edition of Bullseye. Don't forget to like our video and subscribe to the channel. Hit that bell icon so you know when the next episode drops, and we'll see you next Thursday.